Good morning, everyone, and welcome to our DATIQ Weekly Market Update. This is our update for June 27th, 2023. It's our last update for June. Back in studio this morning after a brief hiatus. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst. And we have a very special guest this week. We have Matt Bowerman, who, I love this title, is Chief Everything Officer at Bowerman Trucking. Good morning, gentlemen.
Good morning.
Do you get paid extra for that title, Matt? I just went to MBA school and I didn't run across Chief Everything Officer, but it sounds very alluring.
What was the question?
Does that come with a higher pay bracket?
No, lower actually.
On a per hour basis, I'm sure.
Yeah.
The joys of running
a little intro, Matt, about yourself and your company and why we're so excited to have you on this morning.
Well, I have no idea why you're so excited to have me on. I am Matt Bowerman, as you said, with Bowerman Trucking, and I am from Searcy, Arkansas, and we are a dry van carrier currently running about 130 trucks, about 350 dry vans. And my grandfather started our company with one truck, pretty typical American trucking company story. And my brother and I are now 50-50 partners in the business and have grown and expanded it and diversified it outside of just trucking, over-the-road trucking. So.
Great. Well, we will bring you back at the end. We'll try to get through our things pretty quickly because I know it'll be a good discussion from your perspective on what you're seeing out there. And I know the audience will have a lot of questions. So go ahead and drop those questions in the chat or comment section below. Our marketing team will get those over to us behind the scenes, and we will cover them when we bring Matt back at the end. But to facilitate all that, I'm going to jump into our key points of the week. Let's do that. So van and reefer rates drop slightly. Peak July 4th season spike in spot rates unlikely. This is a very important week. You're seeing this reported across pretty much all freight analytics, news, media, companies that do analytics. This is a big week, typically. I would say that given that the 4th doesn't fall on a weekend this year, there's a potential for next week to also be pretty busy. Obviously a slow start, but probably a busy end. So it'll be interesting to see if we don't see that volume this week, which it's already not looking terrific. I think that could really set the stage for what the rest of the summer is going to look like. So just something to level set on. Spot market volumes and load to truck ratios at 7-year lows. I think Dean's note here is very apropos that it's hard to ignore the 2019 parallels. Dry van contract market, active rates are flat, but replacement rates are down 14%. These contract rates are just stubborn. Psychologically, I'm sure it has a lot to do with getting really great service at rates that are down from where they were at the COVID peak, and shippers not feeling the need to press too hard. But anecdotally, we hear things that contradict that a bit, and shippers getting aggressive on price concessions. Single-family housing starts surged to a 13-month high. Why? I have no idea. Probably Americans' pensions for spending money that they don't have on things they can't afford. The American Tonnage Index is up 2.4% month over month in May, down 1.3% year over year. And then the Michigan State Truckload Ton Mile Index up 0.6% in April, almost 2% higher than 2018 and 2019 levels. So with that, I will turn it over to Dean to walk us through the market update. Welcome back, Dean.
Back with you, Ken. Let's start off with our load to truck ratio in dry van. We'll do a quick market update so we can get back to Matt quickly. Volumes in the spot market, lowest level in 7 years last week, down about 1%. Load posts are about 10% lower than 2019. That's the next closest year going back to 2016, where volumes are reasonably similar. Carrier equipment posts were down last week. Load to truck ratio up slightly from 2.28 to 2.45. In the refrigerated market, after dropping for the 4 prior weeks, reefer spot market volumes reversed course last week. Not surprising. There is some more produce volumes moving as growers get produce into markets ahead of this weekend. But the slow start to the produce season and lagging volumes in California has definitely reduced overall market volumes for temp control carriers. USDA data has national volumes down about 8%. last year, but down about 33% in California. In the overall reefer market for all temperature settings, carrier equipment posts were lower last week, the load to truck ratio up slightly to 3.77. In flatbed, after a solid first quarter due to a warmer winter, flatbed spot market volumes have dropped 35% since the start of April. Load posts were 42% lower than in 2019 and about 71% lower than this time last year. Load to truck ratio down slightly to 9.01. Having a look at some of our markets on our market condition index, on our top 100 lanes, spot rates were up on about 37, down on 38. 25 lanes will remain flat, so pretty even across the top 100 lanes. The market was boosted by higher import volumes on the West Coast. Volumes were up about 18%, as Ken mentioned. That translated into higher spot market volumes off the West Coast as containers passed through the ports and into warehouses and transloading points. Some of the lanes that benefit substantially out of Los Angeles are Stockton, for example. Load volumes were up 4% last week. Phoenix out of Los Angeles up 7%. Spot rates between Los Angeles and Stockton averaged $2.70 a mile last week. That's the highest since February. Loads east to Phoenix, paid carriers $2.69. Remember, folks, these are rates excluding fuel, so they're line haul only. Loads to Phoenix, paid carriers $2.69. That was 68 cents a mile lower, though, than the previous year. In refrigerated, as the produce season moves further north and into the southeast, capacity is tightening in Savannah and Tifton markets. Spot rates are up 2 cents a mile last week to $2.48. Georgia state level rates are just 2 cents a mile lower at $2.48. That's about 9 cents per mile higher than where we were in 2019. One of the high volume lanes I look at in the reefer market on the East Coast in particular is Atlanta to Orlando. Capacity was very tight last week. Spot rates jumped to $3.23 a mile. That's the highest they've been since last August. Atlanta to Hunts Point, New York, the largest produce market in the country, we're running at about $3.07. That's around 28 cents a mile lower than this time last year. And wrapping up with the big produce market on the West Coast in Fresno, spot rates cooled slightly. Rates were down 3 cents a mile last week to $2.39, while in Stockton, home to the largest cherry producing county in Lodi, California, outbound rates increased 3 cents a mile to $2.44. Flatbed capacity was pretty tight in the southeast. It's been like that for quite a while. Regional spot rates across the southeast up 4 cents a mile last week to $2.32. Jacksonville reported some solid gains. Rates were up 14 cents a mile to an average of $2.61 last week. In Savannah at $2.66 a mile, outbound spot rates for flatbed were 6 cents a mile. Lakeland to Atlanta loads were paying carriers $1.28. That's the highest they've been since last September. Flatbed capacity in the Midwest, Chicago and Joliet markets tightened last week. Rates were up 26 cents a mile to $2.78. State level Illinois flatbed rates sitting around $2.45 at the moment. They were flat last week and around 1 cent per mile lower than this time in 2019 in Illinois. Wrapping up our market update this week with our year-over-year look at spot rates. As Ken mentioned, the parallels to 2019 are becoming very hard to ignore as we approach the middle of the year. Produce season typically impacts dry van rates as capacity shifts to higher paying produce loads. And in a typical year, dry van line haul rates would increase by about 13 cents a mile from mid-April to today. This year, that increase is just 5 cents per mile. Wrapping up the national average, look at our spot rates. They averaged about $1.68 per mile last week across all of our lanes. That's just 7 cents a mile higher than in 2019. And in the refrigerated market, normally reefer spot rates heat up in the lead up to July 4. Not this year, though. Spot rates continue to drift sideways. Reefer line haul rates decreased by just over a penny per mile last week to a national average of 2.04. Produce season typically lifts reefer spot rates by around 18 cents a mile between mid-April and this week. That increase this year is just 10 cents per mile. Last week's national average was about 8 cents a mile higher than this time in 2019. And lastly, in flatbed, line haul rates were flat last week. For the second week, national average stayed at around $2.13. That's around 39 cents a mile lower than this time last year, but around 18 cents a mile higher than in 2019. And that's it for this week's market update. Remember, if you'd like to find out more about what's happening in freight, you can go to dat.com/market update and download our long form version of today's report, complete with charts. That'll be published this evening. And with that, it's over to Ken for the short-term forecasts.
Thank you, Dean. Appreciate it. So we're going to do short-term forecast this week. If you remember, we did both short and long-term last week. So if you missed that, you can go watch that episode or shoot us a note, and we will send you high-res versions of those forecasts. So this is the short-term look. It goes out 35 days. The blue line is the about 3/4 worth of 7-day weighted moving average, excluding fuel, long haul only. We always start with dry van. And then you have 4 forecast lines. You have green, which is RateCast, our flagship model. Red is the short term, which more heavily weights near term data. And then the gray and yellow, which are blends of the two. I think what you're seeing here is quite a bit of modeled disagreement after the 4th. I think it'd be more pronounced if we didn't have the y-axis scale the way it is. You're seeing quite a range of values. I think if we zoomed in there, you'd see more disagreement. As it stands now, it's 15 cents worth of high to low range. It's quite a bit over a 35-day window. With RateCast expecting more of a seasonal drop-off after the 4th. In the short-term forecast, expecting some of that, I would say, plateaued strength in rates that we've seen pretty much since Road Check Week, hanging on into mid-July, mid to the end of July. Let's go to reefer real quick. Here's where you start to see some more violent disagreement, for lack of a better term. The yellow model and the red model, so the short-term model and the blended model, seem to think that things will continue, maybe as that late produce start with a stronger finish extending past the 4th. And then RateCast has it going back down as seasonally expected. And then the controversial one this week, it would be flatbed. Just to wrap up, you see, honestly, quite a bit of muddled agreement that things are going to slide backwards. There's a very strong seasonal pressure as we get into the doldrums of summer for flatbed to just kind of plateau off. You see this in a lot of different typical years in flatbed. If you go back to a lot of the charts Dean showed at the beginning, flatbed tends to look like the Appalachian Mountains, for lack of a better term. This kind of build up throughout the spring and early summer, and then the slow drop off as we head into the fall. So that's sad to think about fall already, but that's probably where markets are starting to head as we prepare for peak. It's the next big event after the 4th of July. So let's bring Matt back and get to our question of the week.
Yeah, thanks, Ken. So, Matt, one of the things we chat about in Dallas at the Great West Casualty Conference kind of got my attention was how your company had grown using the spot market in different shapes and forms. So one of the questions I wanted to sort of start off with is, how does Bowerman Trucking strategically use both the spot and contract freight markets?
So thanks for having me. I appreciate that. To answer your question, we started off business model when my grandfather started the company was heavily dependent upon the spot market, and it maintained that through several years and up to a certain size, and then we realized that that size just wasn't sustainable. To remain dependent upon such a volatile situation. And so we began to work towards increasing our customer and contract freight to have more reliable rates and business. But that's been an uphill battle. And especially as we began facing the headwinds we have now. We covered some ground from when we started that project of increasing contract rates or freight. We were at about 10 to 15% or so contract freight, and the rest was on the spot market. And we got up to about 60% contract
Oh,
freight.
wow.
And then
Matt, I don't mean to interrupt you, but over what period, that's remarkable, first of all.
Well, thank you. It was work. We had opportunities, and of course, I like to hold this: blessing follows obedience. I'm sorry. Yes, blessings follow obedience. and so God blessed us tremendously in many areas. And so we over a period of, let's see, that was about 4 years or so, 5 years, that we went from 10 to 15% up to 60%, and grew the fleet from about 50 trucks to let's see, well, it was about 110 trucks or so when we hit that 60% mark.
So that's even more kind of interesting, because I would have, the reason I asked the question, I was wondering how much of that was the COVID wind in your sail versus longer term systemic, right? We talk a lot on the show about secular versus cyclical, right? Where a lot of firms saw an increase in contract because COVID saw an increase in bid events for non-asset and mixed asset players. But it sounds like this has been more of a longer term strategy for you, which I think is even more remarkable considering, it sounds like this effort predated COVID.
Oh, it certainly did. We brought in, I think somebody you're familiar with. I believe they were a recent guest on your show, KSMTA. We brought them in and worked with them for a while in, I believe it was 2017 to 2018 timeframe, to help us start carving out a freight network and defining certain lanes to build volume in and density and help grow that contract business, and just kind of get a game plan. At that point in time, we were about that 50 truck mark, and we were, as David Roush was telling us, we were taking the shotgun approach, and we were just sending trucks all over the country. We were a 50 truck carrier running all 48, and so that was not too sustainable, and we learned a lot from them. So I give some kudos to them and their help and guidance to us. So
yeah, they know their stuff.
Yeah,
we had Chris on the show, David, our former quasi CEO Don Thornton is in with that group as well. So that, they're a powerhouse within the industry, tons of knowledge and experience.
Certainly.
You always trust people that have done it, right? I mean, that's kind of like this industry. I don't want to, we're a pretty no vulgarity show, so I'll abbreviate it, but this is a no BS industry, right? I think you'll see, I was just at a conference last week and there was a panel on venture capital, right? And they almost exclusively look for founders that have freight or logistics experience, which is super rare, right? I mean, most of the time you're looking for like the Stanford grad that has that kind of tech pedigree. And what you're seeing more and more is the money starting to follow industry expertise in our industry, just because it's so hard to BS your way to being successful here. But I think it's the case in your case, and who you reach out for trusted advice or people that have done it before.
Mm-hmm. That's definitely what gave us the confidence to pull the trigger, if you will, on bringing them in, was the fact that they had been there, done that, and they weren't able to pull wool over our eyes, if you will. They knew what they were talking about, and you could tell they knew what they were talking about. So we brought them in, and then they showed us.
Yeah. Hey, Matt, when you went from sort of sort of one-way network to a more dedicated type network where you had sort of, you picked lanes that could work for you. So I assume from that you have pretty good lane balance, and that would have meant for drivers more certainty, more predictability. What was the impact of changing that business model on drivers? You and I talked about this in Dallas. I assume it had a positive impact on drivers when you started to change that business model.
It certainly did. It gave us opportunity to build those relationships where we could increase our drop trailer pools, which is very beneficial, especially in a model that we have with drivers. Our over-the-road drivers are paid salary, not cent per mile. And so it's important for us to increase utilization to have those drop trailer pools, but that's preferred by drivers, even in a salary model, because they don't like that, hurry up and wait. at all. They don't like to sit and wait with not knowing what they're supposed to do next, or just sitting there waiting to be unloaded or loaded or whatever. So most spot freight is live, and so and drivers are having to talk to not just our dispatch department, but then the broker and their dispatch or the individual broker themselves or their tracking team or whoever. They want to talk to the driver as well, and so the drivers get quite frustrated with increased spot market presence. So as we were decreasing that, it was improving just driver satisfaction overall, because they were having less sit time and also less frustrations of the job, having to talk to multiple people about the same thing over and over and over.
Matt, did you say that the drivers were salaried?
Yes.
You did? Okay. That's unusual in the over-the-road sector, right?
Mm-hmm. Certainly is. I don't know of any companies, at least within, and here my southern will come out here, within my neck of the woods. I don't know of any carriers around me that are paying salary, and so we definitely stand out in our area, and with our main competitors for drivers, if you will. But yeah.
Matt, what do you think, had COVID not come along and you continue to execute on your strategy, what do you think is like a long-term ceiling of what your firm could run from a contract perspective? Is it, say, 80, 85%? Do you think you tapped it out at 60, 65%?
That 85% is actually that's the goal. That is the goal? Okay. Right now, that's my goal. That will allow us the flexibility we need to be nimble and execute on opportunities that present themselves, and to take advantage of opportunities within the spot market when they present themselves as well, while not being too exposed and taking on too much risk. Additionally, it just flatlines. I mean, it kind of takes a lot of that volatility out. So 85% is the goal.
I just have one question before maybe we get to Dean, and then kind of any audience questions. So it's always great to be highly levered in the contract market when we're in this time period, right, where spot has just completely fallen off and you're insulated, if you will. Maybe you're not as exposed because your drivers are salary, but how do you think about when the market does eventually shift and contract is below spot, once the spot market recovers and shoots back up? How will that change your short-term strategy? I mean, I know you kind of have level set your long-term, but how do you think that's going to impact your short-term strategy managing both markets?
I don't anticipate it to have a negative impact. We actually have had drivers come to us in both scenarios. I mean, we've obviously been doing this long enough and been in different markets, environments, if you will, to see. We've been paying salary long enough to see different scenarios play out, and the salary model just doesn't really seem to be too affected one way or the other, severely, if you will, by either scenario. It just in tougher times like we have right now, there's we and the drivers as a whole are having to work harder for less. And so while we're in that scenario, some drivers do have that the feeling that they're having to run more miles and get paid less, or work harder, run different hours than they're accustomed to, or in their perception less. But that's not the constant. That's not the average, if you will. And so it balances itself out. I think from one extreme to the other is what we have seen so far.
Matt, question about drivers and equipment. If anybody hasn't seen the Bowerman fleet, arguably the most prominent, hard to miss fleet on the highways, right? With your lime green colors, the EKG down the side, it's an amazing image and brand that you project. So a question about how do drivers feel about that, and does that make a big difference in terms of attracting drivers to your company?
100%. That was if there was any one thing that we did that I could point to as the most significant attractant to our company that we could really put a finger on, it was the branding or the image change of our fleet. It was intentionally designed to look like an owner-operator's truck, something customized like an owner-operator, and to make drivers look at it. Obviously, you kind of pointed out, yeah, they look, and then they're like, I want to drive that. And then those drivers that are here take pride in that because they're constantly out on the road. They're told how nice their trucks look and asked if they're an owner operator, and they, tell them, no, I'm a company driver. And that kind of blows a lot of drivers away. What company were you again? Where are y'all out of? Are y'all hiring? It works. So yeah, it does bring a lot of drivers in, at least grabs their attention, and then builds that sense of pride within the drivers that are currently working for us.
Yeah. Does that translate to your customers also in terms of how they view your company?
I would like to think so. I feel like there are a handful that have told us they really like our trucks. Now, are there let's see. I wouldn't say there's a whole bunch of customers who say, I want Bowerman on my freight just because I like their trucks. But it certainly does give us a different perception. And if you're in the industry at all, you're looking at trucks while they're going down the road. If you're working at a shipper facility of any kind, you're noticing those trucks coming in and leaving your facility. And it's, like you said, hard for them to miss them. And so they give a certain image and presentation to the customer as well when they see them. And hey, I need to look into them. Obviously, if they're going to put that much attention into detail on their equipment, and they're going to take that good of care of their equipment, they're likely to do the same with my freight.
Exactly. Yeah.
At least that's the perception that I feel they have.
Yeah.
Sometimes whenever an interview is not going well, I'll ask someone to name 3 different carriers they've noticed on the road in the last couple of weeks, and they're never paying attention.
Yeah. Right. Yeah.
Right.
Yeah. Hard to miss the Bowerman fleet, that's for sure.
Yeah, I just Googled it while we were sitting here. It's like, yeah, that is pretty cool.
That's amazing.
He squinted.
Yeah, it was bright, but it was cool. I mean, you're so right. I have part of my background was within the expedited space. So those are like the upper echelon of owner operators with the massive sleepers with the tile bathrooms and everything. And a lot of that is kind of rings totally true to what my experience is. Those folks want the nicest trucks. Once they get past owner operators and start building small fleets, that's what they try to attract. A lot of ex-military as well. So yeah, it's a cool marketing strategy, I think.
We spec the interior of the truck and the tech, driver, creature comforts, etc. Everything we spec inside the truck, it is as much of at least as much of a retention tool and a bit of an attractant to our company. But I get more feedback from my current drivers on how comfortable the truck is, how much they like the truck, etc. over the appearance of the truck. After they've seen the truck and want to drive the truck, then they get in the truck and they don't want out of the truck because it's so comfortable and they enjoy it. So we've taken as much care and detail on the specking of the inside of the trucks as we have the outside.
Yeah, that's very clever.
Cool. Well, we're at the bottom of the hour here. The only question we have is about job openings. I would encourage you to go to just Google DAT careers. You'll get a whole list of job openings that are up there. I don't know precisely if we have anything in cybersecurity at the moment, but you can set like alarms for different keywords as jobs become open at the moment. I know we just filled a couple security positions over the spring, so I don't know what's open at the moment, but go give that a check. Any shouts, Dean?
Yeah, a couple of things. As always, Sales Chat is on tomorrow with Dan Deegan and the team, 11 a.m. Eastern. Landline now on Sirius XM, 7 p.m. tomorrow night. Catch Robert Rouse. On the latest edition of Freightvine that's out this week, we've got a big guest, Matt Harding, head of 4PL Data and Analytics at Uber Freight. He'll be discussing the evolution of data science in trucking with Professor Chris Kaplis. Remember, our market update will be published this evening. This week's market update, we are publishing the top 25 habits of successful owner-operators, according to our business partners at ATBS, the nation's leading accounting and tax planning firm. Don't forget, 2 weeks away is Operation Safe Driver Week, July 9 to 15. The focus this year is on speeding. And with that, it's back to Ken to wrap up the show.
Matt, how can folks get a hold of you if they want to drive for you or move some freight?
Well, they can give us a call, check out our website, send us an email, check out Facebook, LinkedIn, we're everywhere. But our number, 800-928-4503, that'll get you to whoever you need to speak to and to drive for us. There's plenty of options on our website to click and go through and check things out. But you can also send an email to apply@bowermanonline.com if you would prefer to do that as well, or just message us on Facebook and our recruiter will message you right back.
Sounds good.
Awesome. Thank you. Really, really appreciate you joining. The only plug I have is DATCon will be here sooner than most folks think. It's in October. It's in Houston this year. We're building a great agenda, a lot of interesting speakers and learning labs and all of that fun stuff that we're compiling at the moment. So I encourage you, again, the easiest way is just to Google DATCon 2023. You'll get all the information, the registration details, things like that. So with that, we're going to sign off for this week. We will not be here next week as the 4th of July falls on Tuesday. We encourage you all to have a safe. We want everyone to come back to our show in 2 weeks with all of their digits. So be safe with the fireworks. But enjoy friends, family. And like I said, be safe, and we will see you in a couple of weeks. Goodbye, everyone.
Bye, everyone.